Hello, everyone, and thank you for joining this Risk Minds webinar in partnership with SAS. So my name is Naeem Siddiqi. I'm a senior risk advisor at SAS Institute, and I'm going to be moderating today's event. Before I start, I'd like to remind everyone that we do have time reserved at the end of the webinar for Q&A. You can send in your questions at any point during the webinar, using the Ask a Question box on your screen, and we will try to get to everyone's questions answered. There's also a resources box at the bottom of your screen where you can download assets and additional reading materials. If you feel the writing is too small, you can resize your screens if needed and make your screens bigger for you. Let's get started. So most global banks have announced net zero goals as part of their plans to be part of the solution to tackle climate change. Today, we're talking about net zero goals and green finance. Having spoken to many bankers, I know you're looking for ways to deal with this and find out what's happening in the industry and how leading banks are planning for net zero. Today, we'll talk to bankers leading this charge, as well as industry consultants helping out. So let's meet our panelists for today. So first off, I have Olli Castrén. Olli is head of economic analysis and impact assessment at the European Banking Authority. Olli is responsible for financial sector research, model development, and analytical impact assessments of new regulations under EBA's mandate, including the Basel rules and European directives such as investment firm regulation, sustainable finance, and digital finance. Next up, we have Mr. Matthew Elderfield. Matthew has been in who is the Chief Risk Officer, of course, and Head of Group Risk and Compliance at Nordea. Matthew has been in some very senior positions in Europe, including as Deputy Governor of the Central Bank of Ireland, at the EBA, at the EIOPA, which is relevant because that industry is also has been dealing with climate change for a while, as well as the Bermuda Monetary Authority and the UK FSA. Third, we have Lisette Stein joining us from Nedbank in South Africa, where she heads the climate risk. Lisette has a background in financial services as well as the fast-moving consumable goods industry, which, by the way, is also an industry that has been quite active in areas such as sustainability and helping out with climate change. And lastly, and certainly not least, my good friend Peter Plochen, whom I'm sure you've met in some of SAS's seminars earlier. Peter helps banking and insurance firms tackle their challenges around finance and risk regulations, enterprise risk management, risk governance, risk analysis, and modeling. And by the way, he also teaches a course on climate risk if you're interested in learning more about this topic. All right, let's move on. Let me, so I'm going to ask our speakers some questions and they'll have a few minutes to answer. It's great to have you all here today. And let me start with you, Olli. You're with the EBA. So tell me, what can European banks expect in the short and medium term from regulators when it comes to specifically green finance and climate risk?
Yeah, thank you very much, and happy to be here with all of you today. So as many of you are probably aware, the European Union published recently its renewed strategy on sustainable finance, which builds on the earlier 2018 action plan. And this action plan has three major objectives. First, reorienting capital flows towards sustainable investment. Second, managing financial risks stemming from climate change. And third, fostering transparency and long-termism in financial economic activity. So on the basis of this umbrella action plan to the in June this year, the EBA published a report on management and supervision of ESG risks in financial institutions. And this report proposes ways of managing and integrating climate and environmental risks in the financial systems. So for financial institutions, it's about definitions, methodologies, and proposals for risk management methods. For supervisors, this report proposes some updated guidelines for the supervisory evaluation process. So let me just highlight a couple of points on this report, which I highly recommend to everybody to read who is interested in these topics. As to the definitions first, so the ESG risks to institutions are defined as risks that stem from current or prospective impacts of ESG factors on counterparties or invested assets. So basically risks arising from core activities of financial institutions. And the ESG risks tend to materialize through the traditional categories of financial risks, such as credit risk, market risk, operational, reputational risks, etc. So there's really nothing extraordinary, and the ESG risk should really be seen in the context of the standard bread and butter risk management function of the banks. There's various methods for the assessment of ESG risks, and these are also rapidly evolving. We go in the report through some of these methodologies, and we don't take any particular stance on their relative performance or merit, but we propose that an application of a combination of such approach on the basis of suitability of particular institution is the appropriate way forward. As to the management of ESG risks, we see need to enhance the incorporation of ESG risks into institutions' business strategies, internal governance, and overall risk management frameworks. So in particular, they should be taken into account to ensure the resilience of institutions and the business models over appropriate time horizons. In particular, the longer term time horizon, which tends to distinguish the ESG risk factors from many of the traditional risk factors. The EBA also recommends that institutions integrate ESG risk in their governance structures, establishing clear working procedures and responsibilities for business lines, internal control functions, relevant committees, management bodies, etc., etc. I would just highlight a couple of next steps which we see in this process before closing up. So how we see the process going forward in terms of the supervisory thinking of ESG risks, we tend to divide the process into 3 stages according to the standard supervisory model, starting from the Pillar 3 disclosures, then moving on to the Pillar 2 supervisory assessment process, and then finally going down to the Pillar 1, the prudential global regulatory framework. As regards to Pillar 3 disclosures, the EBA is planning to finalize its implementation standards, including the ESG risk reporting directives, before the end of this year. So the first disclosure reference date will then be December 2022, so that in Q1 2023, we're expecting banks to disclose ESG information covering 2022 financial year. As regards the Pillar 2, so the supervisory assessment process, the first reference of ESG risks has now been included in the draft guidelines, which is under consultation period, actually until close of business today. The next step will be then to go further to embed these ESG considerations in the next update of the supervisory guidelines, and this is foreseen for 2022. As regards to Pillar 1, we are currently exploring the current framework and in how far climate risk is actually already reflected or should be reflected in there. The next phase there would take into account the developments in terms of data availability and also the rules and standards at the EU level and globally at the Basel Committee level. So this is basically the direction that the EBA is providing for the institutions on ESG risk management and supervisory process for the moment. Thank you.
Thank you, Olli. So let me direct the next question to Matthew. I mean, there are some regulatory requirements here, and I assume there will be more coming in the next years. So what are some of the key challenges faced by banks in meeting these regulatory agenda, or the regulatory agenda, and their net zero commitments?
Thanks very much for the question and for inviting me. And I guess you got the tip of the iceberg in terms of the presentation by Olli. There's a very big regulatory agenda, and it's really growing in terms of its scale and also the speed. I see it accelerating. I think that the starting point for any bank is to have a good inventory of what's on the horizon. There's one big set, I'd say, around the disclosure obligations. What transparency are you going to have to provide? That EBA Pillar 3 transparency disclosure, that's going to be quite tough, quite demanding. That's not till the spring of 23, as we've heard from Olli. But then there's also the taxonomy directive, which is prescribing much more transparency for non-banks as well. But there's an awful lot else too. There's an expectation of the EBA and our regulator, the ECB, to be much better at integrating risk management, as you've heard from Olli, not just into the kind of obvious suspects like credit risk, but into areas like market risk or operational risk or compliance. And maybe we get into greenwashing a bit later on, because that has a key angle to it. And then you've got things like how you classify your investment products. Is this a green investment or not? How do you classify it against the so-called Article 7, Article 8? And then there's a big stress testing exercise just around the corner for the banks. So that regulatory agenda, as I say, big, getting bigger, getting faster. But then you put that to one side, and then there's what we're doing ourselves in terms of managing the risk and trying to support our customers. And as you said, we're one of the banks that has a net zero commitment for 2050. But we've also set ourselves an interim target, one of only 3 European banks to do that, to get our emissions footprint down by 40 to 50% by 2030. So looking at those two sets of challenges, kind of managing the business, supporting the customers, dealing with the regulatory agenda, there's a lot of complexity. There's a lot of issues we can get into in this panel or some other time, but let me start just on 2 and start with data, because I think what gets measured gets done in a bank, and data is crucial here. The EBA pilot that Olli made reference to about the Pillar 3, they have an interesting fact there. The EBA was saying, give us your data for your big corporates, just your big corporates. But as banks, we were only able to get greenhouse gas emission data for 17% of our corporates, only 17%. For all the rest, we had to use proxies. And of course, that's only the big corporates. We've got maybe 2,500 big corporates. Our SME portfolio is 540,000 customers. So how are you going to get data just on something simple like Scope 1 and Scope 2 emissions, so you can measure, so you can do your disclosure, so you can do your stress test, so you can manage your net zero commitments? That's going to be very tough. It's maybe not quite so bad when you start. You start for your biggest emitters. You start with your dirtiest industries, and you can get into that. But over time, it's going to be difficult. I think a few thoughts there. One is that when the taxonomy directive obliges corporates down to a relatively small size to publish more information, that's going to be very useful for banks, because we'll have in the public domain Scope 1 and Scope 2 emissions that we can use for our purposes. That's good. I think it's also accepted that we don't have to get individual customer data. And I think this is something to face into. It's going to be a mix. It's going to be a mix of what you can buy off the shelf, what you can get from individual customers, maybe as part of your credit risk assessment where you're getting information, and then also proxies. So there's going to be a mixture of that. But the question is, will the regulators accept that mixture? For how long? What's their expectations of the detail? And then I think what's going to be really tough is, do we have to validate it? Do we have to verify? If a customer says, my Scope 1 emission is X, my Scope 2 emission is Y, can we just take it for granted? And this maybe gets a little bit into greenwashing, which we can come on to later, which is, how do you trust the numbers? What's the validation and verification, because they're not going to be audited. So that's like the challenge about data right here and now. There's a second challenge, which I would say, which is the trajectory problem. How am I managing forward over time to 2030? The regulators are really putting us on the spot about that, because in the stress test, they say, tell us what your balance sheet is going to look like in 3 years' time. Tell us what your balance sheet is going to look like in 30 years' time. 3 years' time is going to be hard. 30 years' time is going to be really tough. We're kind of trying to figure that out. And then we're also saying, all right, we've got this net zero commitment and get to minus 40 to 50%. What's the shape of the trajectory? How fast are you going to cut down? Probably the benchmark from the NGOs and the public will be, we assume you're going to go straight line down. But it may be actually you need to be lending into some of the brown industries in the short term, perhaps even having a bigger exposure to help them with the transition process as well. So the thing we're thinking about is, how do you manage forward? How do you project your balance sheet going forward? And that's quite tricky, as I say. What's the trajectory you want? And also, what assumptions can you make about how customers will improve? Because if customers get their greenhouse gas footprint down, then it's okay to lend into them. But if they don't, and then again, you've got a validation problem here as well. Validation problem one is the data about the greenhouse gas emissions good? Validation problem two is, you've been given a transition plan. Do you trust the transition plan? Is it credible? If somebody says, I'm going to reduce my emissions by 50%, if you just say, okay, great, and move on, what if that comes back to haunt you and isn't quite so good? So I'd say data and trajectory are quite complicated. There's other issues we can maybe get into, like greenwashing. Those are only the first tier, first order data questions. Scope 3 emissions is going to be super tough to capture. Stranded assets, when you're trying to look at the collateral that you're taking, whether this asset will never be realized. But we can maybe get into that. So I'd say a very big regulatory agenda, a big challenge for banks to support their customers, get to net zero. And the starting point is getting good about data and getting good about forecasting where you're going to go over the next 3 years and even 30 years.
Thank you, Matthew. Great points. And I come from the world of credit scoring, where we build 12-month models, and we're taught to be skeptical about those. Building forecasting to 30 and 50 years is definitely going to be a challenge. And a lot of banks see that as directional for now, where the trajectory is going. But great points being made there. Lizette, let me ask you a couple of questions. So we've had the regulator, and we've had Matthew explaining some of the issues going on with the calculations. But this is more than just a regulatory exercise, right? And it's important to manage this across the business in a bank. So how do you see the climate risk function being integrated into your business as usual risk and finance and other processes within the bank?
Thank you very much for the question, Naeem, and I agree. It's more than just regulation. So I just want to essentially just quickly take a step back. It's very important to look at the three basic building blocks for climate risk, which is the physical impacts. We've seen the extreme weather events. It's getting more severe on an ongoing basis from the US, UK, Africa, etc. Then there's the transition impact, which Matthew touched on quite a bit, where we have to transition from this high carbon economy to a net zero economy by 2050. And then there's a liability risk on specific bank or on financial institutions, where they can be held accountable for the contribution of the greenhouse gas emissions through the lending book. So all in all, if you look at these three concepts, it's systemic to everything that we do as a bank. So it's important to integrate, and I think Olli made the reference that it will be integrated into all activities. But as risk managers and finance managers, we should integrate this into our long-term sustainability, and we should make sure that we're sensitive to the societies in which we operate. So as earlier mentioned by Matthew as well, it's extremely important to look at it from the various lenses, so how we operate. So essentially, if you look at your operations, you need to be operationally resilient from an operational perspective. Is your staff, your networkings, and all of that, how that's how your BCPs on that, so about business contingency plans. And then from a lending perspective, how do we tilt our lending books from a more from brown assets to green assets, and then ultimately how we invest. So it is quite a mammoth task to reduce the carbon intensive sectors in line with inequality and poverty. So I just want to take an example and a step back. We've heard a lot from the high level thinking, and which is great, but just from a practical example, if we look at the client at the heart of everything that we do. So let's take the credit risk examples. If you look at the affordability from a client, that is very simplistic if you compare it in with the lenses that we will have to add from a climate perspective. So essentially what you'll have to do is you'll have to look at your client's physical location, and are they operationally resilient? So where are they located? How will they be impacted by droughts or sea level rises? And then to Matthew's point on the transitional perspective, like how do you support them to transition from a high carbon supply chain to a low carbon supply chain? And what is the actual capital requirements? What will happen to their gearing ratios? And then in this transition, how do you actually support the technology? Because there's a lot of developing technology, so that poses technology risk. And then in addition to that, we will have to start looking, or we have to look at the scope 1, scope 2, and scope 3 of the clients, which get very granular. And then ultimately, we need to make sure that these clients are resilient from a strategic perspective as well. So it's operational and strategic. Then on the upside, I don't want to be just doom and gloom, because I do believe there's a lot of opportunity from a climate risk perspective through the sustainability finance lens. And as I mentioned, we need to make sure that we're sensitive to the environment and the social environments that we operate in through the appropriate governance structure. Then from a financial perspective, we need to make sure that our stress scenarios actually inform our income statement and balance sheet. As mentioned by Matthew, the timelines is getting a lot longer. So we will need to enhance the way we do scenario analysis. And just from that, we can spend a whole lot of time unpacking the traditional risk types, markets, operational credit, and then C-suite, like conduct risk, etc. The reality is climate risk integrates across everything that we do from an enterprise perspective, and across the various functions. So just a few on how to do this from an integration perspective. It is extremely it's an extremely big task. Nedbank's approach that we took is we put together a cross-functional climate task team, and they're responsible for identifying, measuring, monitoring, and managing these climate risks and opportunities. It spans across the enterprise. In support of that, it's very important that you train your staff to make sure that they're integrated in what they're currently doing. So it's important to have fit for purpose. So that's just a bit on the how of the integration. And then just to conclude on this, it is very important that risk managers and finance processes include and integrate climate risk and opportunities into budgeting periods, into the way we manage risks, to ensure that we're climate resilient and to be more resilient from a financial industry perspective. That's all from my side, Naeem.
Thank you, Lizette. And thank you again for reminding us that this isn't just a defensive play. It's not just about managing the risks. There is a lot of opportunity out there again, you mentioned sustainability. There's green finance. A lot of banks are looking at changing products, at bringing in new products to cater for changing consumer tastes, of course, which is part of transition risk, to avoid transition risk. So thank you for that. Peter, so we've had bankers talking about managing the risk of climate change, and Lizette, thank you, as she also mentioned the opportunities out there. Is there a role for technology here? So how can it help banks do all of this more efficiently?
Thank you, Naeem. Thank you, Lizette, Olli, and Matthew for sharing your perspective on this. Absolutely. So when we talk to banks around the world on the impact of climate on their processes and technologies, we clearly can see that climate is hitting all different processes within banks, as also Lizette mentioned. And behind those processes, there are also underlying systems and technologies. So whether we're talking about climate data and sourcing of the data, as Matthew indicated earlier, what do we do with that? Where do we source them? Or whether we're talking about all the new measurements, calculation, disclosures that Olli has shared with us, and the EBA plans, which are quite significant. And last but not least, how we are going to manage forward. How do we look at the future? All these aspects are being hit by climate significantly. And depending on how mature and efficient the bank is in doing these processes already before climate, that will also depend on how effective are they in responding to these new challenges. And it could be that climate is the trigger that will motivate them to modernize, to do things more efficient, because they realize if this is taking too long, this is ineffective, it will require a lot of effort to configure this, or also could be a trigger for digitalization and new innovative approaches. Just to give you an idea about innovation, we were exploring and are exploring the usage of AI and machine learning techniques for natural language processing to automate crawling through corporate websites and downloading all climate-related information and disclosures, including TCFD and the emissions, how to automate that process and use AI techniques to digest this new information and generate indicative ESG and climate scores. That's just one example of how the latest development in technology could support our initiatives here. And there is a parallel dimension for this discussion where when we are thinking with banks on how to actually efficiently incorporate this into the underlying processes and in technology, what is very important is also how can we automate most of this? How can we also manage and govern this so we can explain what is happening in our infrastructure, and when there are numbers coming out, how can we be sure that they are the correct ones and we can explain them? And last but not least, as Lizette also mentioned, everything is connected to climate. So how do we integrate the new climate activities and the underlying processes and technologies with our existing BAU processes? So these are examples of the discussions that and thoughts that the banks around the world are having. And for example, one of the prominent topic when we think about climate risk data analysis is the usage of geographical information. For example, ECB has shared in their stress test this nice visual map showing European areas exposed to different types of physical risks. And obviously you want to connect where my corporates are, but not just the headquarters of my corporates or customers, but also their physical assets. So how do we collect that information, and how do we also visualize and analyze it? Because there's a lot that happens behind these nice pictures. For example, in our physical risk discussions with in one country in Europe, we are looking at public data source that is able to distinguish the physical risk impact on street number level, right? So two corporates or two customers on different sides of the same street can have a different physical risk exposure. How do you actually bring this into your data structure, analytical structure, and also in the end report upon this? So these are just examples of the new things that climate is bringing on the top of the traditional BAU risk processes, because the geographical aspect of the physical risk was not something that banks were necessarily leveraging much before, but they will have to do it going forward. And this might trigger some impacts also on underlying processes and technology. But going forward, to manage the forward, as Matthew put it, this is probably the most favorite area for myself of climate risk technology. So how do we actually look at this from banking perspective when we're thinking to understand the impact of different climate scenarios going forward on our portfolios and bank KPIs? And obviously, as Matthew already mentioned, I mean, we don't expect, it's not realistic to expect that our portfolios will not change. They will evolve, the customers will evolve. So what we need to do is also try to think, and what banks are trying to do is to assess not the impact on the current portfolios, but impact on future portfolios. And obviously, future portfolios are not carved in stone. They are the result of the strategy and planning and decisions that we take today. So we have obviously a lot of alternatives, portfolio mixes. Each of them will have different impact on our KPIs. And with climate and net zero, we have a new kid in the block, the carbon footprint, which is additional KPI we want to manage in our portfolios. So if, as Matthew said, you want to decrease 40% your carbon footprint in your portfolios by 2030, there are a number of ways how you can do this. There are many roads that lead to net zero, many alternative portfolio mixes, each having different impact on carbon footprint and impact on risk profiles, capital adequacy, and very importantly, let's not forget the bottom line, the profitability. And obviously, this is not a trivial thing to analyze and simulate. We have experiences from our stress testing discussions already from years ago, where we would come across and talk to banks that they would be struggling to run one stress testing or scenario simulation in order to assess the impact on their portfolios before climate even. And it would take them a day to do one calculation. If you have 3 scenarios, climate scenarios from NGFS, for example, it would take 3 days. If you want to assess the impact of 3 portfolios, alternative mixes, alternative decarbonization strategies, suddenly you have 9 calculations to run. And then, you look at almost 2 weeks running time. That really impacts the maturity of your underlying infrastructure, really impacts what you can achieve business-wise with these processes. So if we want to go beyond just compliance, we want to use the result of scenario analysis for business decisions, then the role of supporting technology will be very important. And to conclude with just one example of how smart technology choices could help us to get deeper into net zero and maybe make smarter choices, is important element of climate is the understanding of different impacts of scenarios on our portfolios and our decarbonization strategies. So for example, if we want to analyze the impact of our 2 climate scenarios on our portfolios, we see that scenario A here on the left side, the bar shows us a 1.2 billion impact on our portfolios, and scenario B on the very right side is 300 million. So obvious question from the regulator, from us, our board would be, why is one 4 times higher than the other one, right? And to explain that, we can leverage capabilities that will decompose this impact into different categories. It's not easy maybe to read, but so we can explain the impact of transition risk, physical risk coming from these scenarios. And that could also help us to determine which portfolio alternative mix will perform better. So we can take this to a portfolio comparison, say decarbonization plan 1 and versus 2, and the same scenarios. Why is it that one portfolio mix results in the 4 times higher losses when they have the same decarbonization impacts, right? And this analysis can be extended further even to individual customer level, because for the top exposures, we need to do this on the individual counterparty level. And understanding the exposure of these counterparties, individual exposures, would be beneficial for our one-on-one discussion with these customers going forward. Unfortunately, to be able to do this analysis, as like I showed you already, it requires a lot of design choices up front, because this requires a lot of additional simulation runs, because to decompose these impacts, we need to rerun simulations, adding one set of factors at a time, right? So let's just transition risk factors, rerun, then at a physical risk, rerun, etc. So suddenly we're talking about dozens of calculation runs in order to produce this information that can support our decisioning. And therefore, it suddenly makes a lot of difference how efficient the underlying infrastructure is, because the maturity of the infrastructure in the end will determine how much business benefits can you take from this exercise. That will be all from me for now. Back to you, Naeem.
Thank you, Peter. Some good points made, and I just want to remind myself, when we're talking about climate risk to one of the largest banks in the world, the head of climate there, GSEB, said this would be the climate risk would be the biggest big data project that the bank has faced. So it is a problem not just of getting the data, but once you get that big data, what to do with it. So thank you, Peter, for some of those great points. Now, I know the EBA stress test has been mentioned a couple of times. I'm just wondering if, Olli, if you can say a couple of words about that test before we move on to polling questions.
Yes, certainly. Thank you. Thank you very much. So indeed, it was mentioned here by other participants that we run a pilot climate stress test exercise in 2020-2021. I think we should definitely stress and keep in mind that this exercise was from the outset designed as a learning exercise in order to investigate how essentially existing and newly developed climate risk assessment tools perform and to help and test the bank's readiness to deal with the related data and methodological challenges. So it was really a learning exercise and a test run. So this exercise was run on a sample of 29 volunteer banks, which provided data on non-SME corporate exposures, as Matthew was mentioning. So clearly we had to exclude a very significant chunk of the corporate loan book. But this was simply done for feasibility purposes and given the time constraints that we were running and also availability of relevant data on SMEs for the banks. And the idea was to focus on the identification and quantification of exposures from a climate transition perspective. So we didn't look at the physical risks in this particular exercise. So the results show that more than half of the bank's exposures that were covered by the exercise are currently allocated to sectors that might be sensitive to transition risk. Similarly, like 35% of the known SME corporate exposures are to obligors with greenhouse gas emissions above the medium of the distribution. So the kind of complicated exposures, if we want to use that expressions, are significant depending on the measurement tool applied, but basically the taxonomy related measurement that the banks were themselves asked to use clearly show that more than half of the exposures can be classified as sensitive to transition risks. We also found, not surprisingly, that banks are currently in a very different development phases in order to assess the greenness exposures. And we also found that the impact of climate-related risks varies a lot across banks, and it also tends to be concentrated on certain sectors, which is also clearly confirmed by the results of the ECB's top-down exercise that was recently published. Then basically looking forward, so we continue to work on these issues. We continue to develop methodologies. We continue to improve the data. We continue our dialogue with stakeholders, particularly industry participants and the peers at the ECB, the Basel level. The global discussion is very important in this context in order to get the global standards and global methodologies right from the outset. I think that's what I wanted to say at this stage.
Thank you, Olli, for that. Good. So we've heard from Olli, we've heard from bankers and SAS. Let's do some polling to get a pulse on what our audience thinks. Our first question is coming up. If you can put up the first polling question, please. So I know, and Matthew mentioned this a couple of times, the greenwashing, the issue of greenwashing. So our first question is, what is your perception of the decarbonization plans announced by corporates, investors, and banks around the world? Right? Are you positive about this? Are you skeptical? Let us know. So let's give them about 30 seconds to respond to this question. All right, I think we're good. If we can check the results. Very good. So very interesting results here. Well, 60 around 57% are a little bit skeptical, not sure where this is going. But the good thing is Only about 14% think this is mostly greenwashing. And that's good, I think, from my perspective. And so I'm gonna ask the panel this: given what you see here, with the increasing concerns around this whole greenwashing, carbon washing issues, how do banks allay these concerns? Right. Let me start with you, Olli, and then we'll go to Matthew next.
Yeah, so certainly, yeah, I'm not too surprised maybe to see that that the audience is inclined to be skeptical about the statements, because obviously also what we already heard in this panel discussions as well is that the challenges are immense. They are not immense only for the industry; they also immense for the regulators and supervisors who need to police and stress test these new rules. However, what I would say is that the data availability and the data quality is deemed to improve. Not least because of the corporate sustainability reporting directive that is coming into the force shortly, and this is going to oblige non-listed companies in Europe to disclose climate-related information, and SMEs are also voluntarily allowed to participate, by the way. So the data availability, data quality is deemed to improve, and this is of course a key issue for the banks and supervisors alike to make this agenda credible and allow reporting to be trustworthy.
Thank you, Matthew. You want to add to that?
Yes, so I think this isn't a surprise to me as well, that everybody is very skeptical about what's happening here. So to my mind, as a risk manager, as a chief risk officer, you have to be very alert to this and treat this as a risk in and of itself. Greenwashing is a risk category, if you like. So what are your controls about that? How are you policing this? And maybe just to give 4 areas for people to think about, to take away. One is when you're doing these calculations, which can be fiendishly complicated, what's your proxy, what's not your proxy, is it scope 1 or scope 2? Write down your methodology. Have that as as a control process. Be very clear how you reconcile to the PCAF. This is the climate accounting standards, and be transparent about it, and be humble to say it's going to change over time, so that people know how you're doing the calculation. I'd say, secondly, in an area like your investment products that I mentioned before, use your traditional compliance processes. All right, your first line colleagues are going to say this is a green fund. Double check, be skeptical, use your compliance officers, use your lawyers to check on that. You can get into real trouble. There's been a lot of FT coverage recently, hasn't there, about people skeptical about how many green funds are out there. You really want to be confident about that. Thirdly, then you're issuing your own sustainability papers and updates in your annual report. Really review carefully what you're saying. Don't be tempted to overstate and de-risk your wording. Be cautious and have good checks and balances in that. And then maybe not such an obvious one is keep an eye on your people on social media. If you've got your leaders, maybe middle-ranking leaders, getting on social media, making very brave statements about how green their business is and what they're doing, can you stand behind it? So you really have to have a structured approach. I don't think a big bank like us isn't going to do greenwashing on purpose. It's going to be by accident if it happens. So you need to control it. You need to manage it as a separate discipline and be alert to how you do your calculation, what you're saying publicly, and what products you're offering to your customers.
Excellent. Good points. Good points there. Lizette, do you want to step in with your view?
Yes, thank you, Naeem. Matthew, I agree with you on your 4 points. Just to add into that, we need to make sure that we have effective check and challenge across the 3 lines of defense. So you need to work with your business, your data teams, your compliance, your lawyers, and your quants to make sure that the data is valid and the calculations is correct. Then you will have to work with your business teams to make sure that there's a lot of accuracy in the deals that is captured, as well as you need to write down your standard methodology used to make sure that it applies across the enterprise. So that's just a few key points from my side. Yes, thanks for that.
Thank you, and thank you for reiterating this. I mean, we know there is opportunity with sustainability and the climate risk issue, and what banks do has to you have to be able to take advantage of those opportunities in a credible way, without arising all these greenwashing issues. Lastly, Peter, do you have any thoughts on this?
Yeah, sure. Just to add to all the points that are very valid, and I fully agree with them. I think there is an opportunity for banks to team up to solve this challenge, right? I mean, how do we, should we all 55 big banks estimate carbon footprint of the same corporates, right? So we have seen the cooperation of banks working pretty well, for example, in low default portfolios where banks would be sharing data in consortium structure, such as, for example, the global credit data. So I think there is a potential for banks to team up to and benchmark their estimates on, for example, and share their estimates on or information that the data that they use on the, for example, this carbon footprint. So that could be also done, because the question is posed, what can banks do, right? I mean, ideally, regulators would standardize this and make it available. But if it's up to banks, maybe that's also a dimension that could be explored.
Awesome. Thank you, Peter. Let's move on to our next question. And this one is on stress testing. I know Peter talked about some of this, and Matthew also discussed some of the issues here. So, for banks, what do you see as the top challenge for you to perform the climate risk stress testing? Is it lack of appropriate methodology and data? We've talked about data. I mean, the other issue, of course, is methodology that a lot of folks are struggling with. How do you even predict 30 years? Is it a straight line, and should it be a straight line, for example, things like that? We've talked about integration with business decisions, other functions. There is, of course, the stress testing infrastructure. A perennial problem with analytics at banks, where building lots of models, doing lots of analytics, that the formula is the easy part. Building the model can sometimes be easy, but deploying it into production, for example, linking it with your risk and finance infrastructure, for example, can be a challenge. So is it the risk? Is it the stress testing infrastructure that is the issue? So let's give them another 10 seconds or so to answer, and then let's look at the results. Okay, very good. Well, there's an overwhelming response. It is the lack of appropriate methodology and data. Very good. I mean, this is again not a surprise to the panelists. I'm going to go to you for this. What are the top issues on your mind as you prepare for the climate risk stress test? Regardless of whether it's going to be a regulatory one or it's for internal purposes. And let me start with Matthew, and then I'll go to Olli next for this.
Yeah, I think all three of those areas will be a challenge, but I would agree number one will be data. I think you talked about it yourself about it's hard enough to do the 1 year horizon, and Peter also built on that by saying you're doing multiple scenarios and how to deal with that with your stress testing in infrastructure. It's going to be quite a challenge, I would say. I think that gets to my mind is like, what's it going to be used for? Okay. I think it's really important for regulators and boards and banks to realize we are in an exploratory phase. All right, the clock's ticking with the IPCC very downbeat assessment over the summer, but it's going to take a while to figure out this data and to use it effectively. And I guess that bridges a little bit, because stress tests can be used to find your exposures, learn about your ability and the rest of it. The thing I'm nervous about, and I share, is the risk of the regulators going right to capital, really fast on capital. And Andrew Bailey said the Bank of England assessment, it should not be about capital. The French central bank has said that. From the European authorities, it's a little less clear. Maybe in the short term, the EBA is saying that. But there's this pillar 3 to pillar 2 to pillar 1 journey that Olli mentioned. And I would say a couple of things that I think we have to be cautious about banks' prudential capital being used as this major lever for societal change. It should be about risk. You know, it may be that green SMEs are not less risky, so shouldn't get a capital bonus. And maybe that some brown customers aren't more risky, so there shouldn't be a penal element. And then the other thing I think to be aware of this is the risk of unintended consequences. Because if the regulators use the stress test too quickly to load up capital for the brown industries, you're going to discourage this transitional lending. And then that's going to be very tough. So there's a real law of unintended consequences. So let's do the stress tests in a partnership, recognizing these data challenges. Let's iterate it and learn. But let's be cautious about jumping from this to say, you know, we need to have a heavy Pillar 2 charge or a Pillar 1 charge, because that could choke off the financing that the economy needs to go green.
Olli?
Yes, thank you. Yeah, no, I think, look, I share very much the concerns that Matthew was expressing here. I mean, I think it's kind of time to understand as well that the transition is going to be costly. It's going to be complex process. It will have repercussions to the society which go beyond what probably have been thought about when the kind of initial agendas for greening of the systems have been built, and people are only now becoming acutely aware of them. But at the same time, I think, as has been made clear in the reports of this recent stress test, is that we don't really have a choice. So something needs to be done, and we need to follow basically the guidance that is provided to us by the policymakers. But when it comes to the kind of practical challenges in terms of stress testing in particular, so obviously the key challenge that we are faced with is the time horizon, which is going to be very different in ESG and environment related stress testing compared to the traditional stress testing. So traditional stress testing typically uses the maximum 3-year horizon, which is also very similar than kind of traditional macro scenario analysis, whereas here we're talking about 10, 20, 30-year horizons, which makes it more complicated just technically to design these tools. At the same time, I think, you know, look, there's a lot of research being done on this area since last 10 to 15 years, and I'm quite confident that the analytical academic community will come up with usable tools relatively quickly. And I think the ECB stress test already shows you that many of these challenges can be overcome. But at the same time, I think it's really important, both from the regulator, supervisor, and the industry perspective, that we will be able to build reliable and usable models which don't rely on too many assumptions or technical glitches or simulations. So that's certainly going to be the way ahead. And I fully agree with Mathieu that this is something that where the cooperation between the different stakeholders is going to be very important.
Thank you, and I'm going to go to Lizette and Peter for quick answers to this one. Do you have anything more to add?
So just to add to that, it's very important, the IPCC report that Matthew mentioned that was released in early August. It's very important to take into consideration that the outcome of the increase in temperature is not going to be linear. So when you stress a 1.3 outcome against a 1.5, it sounds fairly small, but the impact of it will be significantly different. So that's just what I want to add to the scenario points. And just additional point to add to what we use it for, I think it's very important that we use the scenario analysis as a tool to inform our strategy, rather than just a regulatory stick, if that makes sense from a practical perspective.
Great, thank you, Peter. Any last word on that?
Yeah, just further expanding on what Lizette just mentioned, I think the challenge will be how we can make the best usage of this exercise, right? So for now, for the next year in Europe, everybody's going to struggle with the lack of appropriate methodology and data. How do we make something fly within a year? But it would be a pity if we take steps and design things in such a way then I forget about the next step. How do we make usage of that? Because for business decision, how can we run this 10 times instead of once a month? And because there are certain things we need to think up front about and design things, which is how do we roll it out and expand this to the across the entire organization. And that really much also touches on the how, and the technology is also part of it.
Thank you all for that. Those great discussions. I know they've generated a lot of interest and questions from the audience. I'm going to just move to the Q&A section of this panel. Maybe ask the first question for quick responses from our panel. One of them is this: will ESG have an impact on the risk-weighted assets of the banks? Because we're talking about green finance here, right? If ESG has an impact on the risk-weighted assets of the banks, is that going to encourage a faster transition towards green finance? Let me start with you, Lizette. Do you have anything on that?
So I think it will definitely have an impact. It is definitely something that we need to consider from a banking perspective. Yeah.
Thank you. Anybody else have anything to add to that? Is ESG impacting the RWA going to make you go faster to green finance?
I think for sure that the expectation of our regulators and what we want to do ourselves is to incorporate ESG factors into our risk analysis for credit risk. So, because I'm a bit skeptical about the regulator sort of pressing down on green and brown, but we ourselves need to say, all right, lending to Elderfield, very high risk transition area, we better increase the probability of default. Lending to Lizette, maybe not so big probability of default, but all these assets she's never going to be able to get out of the ground. So that'll go into the LGD and the PD, and that will feed into the risk-weighted assets. And that's part of this planning horizon that we're going to have to do. So it's bound over time to create an incentive for sure.
Thank you. Let me move to the next question. Just the last one here. Quick. Is it not dangerous for regulators to be so specific that climate risk does not pose a unique risk, given there is so much work that is still need to be done to fully understand this risk? For example, are we clear how physical and transition risk interacts or impacts economic variables? Would that be a unique risk, or is this a different use case for existing risk in the bank? Lizette, do you want to answer this?
Sure. That is a very good question. So to the question of very unique risk, I agree to some point, because if you look at it, climate is very unique in the nature of it. So to my earlier point around that it's systemic to everything that we do. So I think that will change the landscape of how we do things. Ultimately, we need to consider this from a unique perspective, but sometimes if you say something is unique, then you want to go back to base ground. And I believe that there's a lot of risk that we can leverage on, and practices and learnings that we can apply. We just need to do the integration of physical transition risk from that perspective.
Thank you. I'm going to throw that question out to the rest of the panel.
The way I'd say it, it's definitely a distinctive driver of risk, but it will manifest itself in your traditional existing risk taxonomy. Is this coming through on market risk, on credit risk, on operational risk? But it's certainly a common driver, which is very important for society and for banks, but it appears in these other existing risks.
Right. Thank you. Thank you for that.
Olli,
go ahead.
Yeah, just to add that, yes, it's clear that the mapping of these ESG risk factors to ESG risks and further to the traditional market credit liquidity risk is something where we need to do a lot of work still. There's a lot of room for research here. We need to improve this mapping, that's clear. And it's particularly the case for transition risks, I would say. On the physical risks, maybe we could learn something about what our colleagues on the insurance side are doing. So they have a long history already pricing physical risks. into insurance premium. So I think there's a lot for us to learn from that side, but the transition side is certainly something where a lot of work needs to be done.
Thank you, Olli. Peter, if you want to add something, you got 30. I'll give you 30 seconds for last word on this.
Yeah, last one. Yeah, I agree with most of what was said, and I would say, from my perspective, I'm not that concerned about naming conventions and what we call what. The important is that the fact that these risks need to be analyzed somewhere and considered somewhere. So that's, I mean, from that perspective, the analysis needs to be done. However it's called, that's the secondary issue for me.
Exactly. You got to face the problem appropriately and with credibility. Not get bogged down with semantics. Thank you very much, panelists. Looks like that's all we have time for today. Again, Olli, Lizette, Matthew, Peter, thank you for joining us today and enlightening us on the topic of green finance and net zero. And thank you to your audience for your participation. I look forward to seeing you all on October 28th for the second webinar in this series. And the second one would be on stress testing and climate risk modeling specifically. And before you close the browser and leave us, please do stay on for an extra minute to fill out our survey. And this is available on your console already and will pop out for you once the webinar has concluded. I hope you enjoyed today's panel as much as I have. Have a great rest of your day. Thank you.